Hey everybody, it's David Jenkins with Fomble Morrissey Realty. I'm a residential real estate agent here in the North Carolina Triangle. And I want to talk about the real estate closing, one of the last things that happens in the process of buying and selling real estate. Now if this is a cash sale, many times buyers and sellers don't come to a closing. The seller can sign the deed and lien waiver in advance in front of a notary, and the closing disclosure can be, depends on the attorney, but many times docu-signed, or at least signed and scanned and send that in. Don't need originals. It's when a lender is involved that people are sitting around a table. And usually it's just the buyers sitting around the table. Again, the sellers usually don't come to closing. They sign the documents, the deed and lien waiver, in front of a notary in advance. And the closing disclosure, they can either have their agent sign it for them with a limited power of attorney, or they can sign it and scan their signature. The closing disclosure, the document with all the numbers on it, which we'll discuss in just a minute, does not have to be notarized. The buyers come to closing and sign so many papers they get cramps because the lender is providing all of these documents. And usually after the buyer signs all those lender documents, the lender wants to see them, so the attorney has to scan them and send them to the lender for the final approval for the loan. And then the attorney can record the deed when the lender has approved all the papers and the attorney has the necessary funds from both the buyer and the buyer's lender. All right? So I'm going to take you now through the paperwork, first looking at the seller disclosure statement and then looking at the buyer disclosure statement. So here we go. Okay, here I've got this outlined, and plus we'll look at the paper. We've got the seller's closing disclosure from January 2019. This was a real closing. I was representing the buyer. Let's take a close look at it, better understand it. We've got a purchase price of $312,500. We're going to give the seller a credit for HOA dues that were paid through the end of the year. This subdivision, the HOA dues were less than $200 a year. I don't remember, it's like $180 a year. And so the seller was only in the house for 11 days this year, and so for the whole rest of the year, they're getting a credit for that amount. So the total amount due to the seller is $312,669.73. How come the seller's not getting a check for that amount? Well, the settlement agent needs to pay some bills for the seller. One thing is the seller's closing costs. Most of that is commission, but there's some other charges to the seller on the next page. We'll get to that in just a second. But the total closing cost the seller's paid is $20,425. And then the settlement agent is paying off the seller's mortgage balance, which in this case is $246,136. So if this closing were taking place at the end of the month, the seller would need to make sure to cancel any auto payments. Don't pay the mortgage. That'll be the attorney a few days before the closing is going to reach out to the seller's lender and say, what's the payoff amount as of such and such a date? And that's assuming the seller makes no more mortgage payments. So don't make any last minute payments. If you forget and make that extra payment, the money's not lost. Your lender will refund it to you in 3 or 4 weeks, the overpayment. All right, but the settlement agent is going to pay off the mortgage for the seller. The seller in the negotiations in this particular transaction, the seller negotiated with the buyer that the seller would pay $6,400 of the buyer's closing costs, of the buyer's expenses, and that negotiation was done in the due diligence period when the buyer found there was some need for repairs and the seller agreed but didn't want to make the repairs, so there was a $6,400 credit in lieu of making repairs. That's where that came from. Then the seller already got paid a $2,000 due diligence fee. That counts towards the purchase price. The seller already got that check and cashed it. The attorney is prorating the property taxes, and this is an estimated amount because this is in Durham County. The tax bill comes out in July for that year, in this case for 2019. So the tax bill hadn't come out yet. But in January, the attorney's saying, let's look at last year's tax bill and prorate it, and for 11 days for the prorated bill, came to debiting the seller $102 for the seller's estimated portion of the 2019 property tax. So when you add all these things up, the amount due from the seller is $275,063, and the difference between that and the amount of money due to the seller would be that the seller is going to be getting a check from the attorney or having it wired to the seller's account in the amount of $37,606.28. Now let's take a closer look at the seller's closing costs on the next page. Now in North Carolina, there's an excise tax of $2 per thousand charged to the seller Unless, of course, you're buying new construction, then you need to look very closely at the builder's contract, because sometimes in that small print on new construction, the builder is putting this charge over on the buyer's column. But it's $2 per thousand, so you just strike off the last three numbers and multiply it times 2. So in this case, 312.5 times 2 is $625 excise tax, or revenue stamps, charged to the seller. In this particular transaction, there was a 6% commission, split 3% paid to the listing agent's firm and 3% paid to the buyer's agent's firm. Doesn't have to be that way. That's just the way it was in this transaction. So that's a debit to the seller of $9,375 and $9,375 for the two sides. Then the attorney is charging $50 to overnight to the seller's lender the payoff for that mortgage. There was a homeowner association assessment that the seller is paying of $300, and then it's very typical for the HOA to have it in there that when a seller sells a property that the seller has to pay the HOA to redo the files and things like that. And then the seller is paying the closing attorney $150 to prepare the deed and lien waiver. And in this particular transaction, the listing agent, I was representing the buyer on this one, but the listing agent charged the seller $550 in addition to the commission to do for some staging services. These add up to $20,425. Those are seller closing costs. And so I think that pretty well explains that. Let's take a look over at the buyer's closing disclosure. All right, so on the buyer's closing disclosure, the very first page just reviews the loan and the purchase price and things like that. In this particular case, sales price of $312,500. The borrower is putting down 20% and borrowing 80%, so borrowing $250,000. This particular one was a 30-year mortgage with a fixed rate of 4 5/8%. So the monthly mortgage payment, principal and interest, locked down for 360 months is $1,285.35. That number will not change for the life of the loan. But every month it'll be a different ratio between the amount of that money that's paid toward principal and the amount that's paid in interest. Within the very beginning, the majority of the money being paid every month to interest, and at the end of that 30 years, those last few months, the majority of that money is paying back toward principal. So if you were to come in to say an extra $30,000 and you're like, let's throw this toward the mortgage and get it paid off, it wouldn't change your monthly mortgage payment. But what would happen is the next month, the ratio would drastically change. After you put that extra money, that next month, more money percentage-wise than would have happened is going to be paying back the principal rather than paying interest. All right? And then in addition to that fixed monthly payment of $1,285, there's an escrow account. In this particular example, there doesn't have to be an escrow account, but there usually is. And this is not fixed. It'll go up every year as property taxes tend to go up and insurance tends to go up. But for this first year, it's an additional $371.28 a month. That's building up that escrow account. So a year from now, there'll be plenty of money in the escrow account to pay for another year of homeowners insurance. And when taxes are due, there'll be plenty of money in that escrow account for your lender to take out money and pay your property taxes for you. So for the first year, the monthly mortgage payment is this $1,285 plus the $371 is $1,656 a month. All right? Now let's dive in deeper and take a closer look at these numbers. All right, so on the top of this next page, by explaining the buyer's closing costs, we've got a loan origination fee of $995. Now, it doesn't have to be that much. That's just what this lender does. You may call a lender and say, what rates can you give me? And the lender might say, well, what rate do you want? You might think that's the most ridiculous question you've ever heard. But it's actually a very good question. What the lender is saying, in other words, is, are you going to stay in this property for a long, long time and you want the lowest interest rate possible, even if you pay high fees? Or are you only going to stay in this house for maybe 2 or 3 years? You wouldn't mind having a little bit higher interest rate than I could give you, but you'll have very low fees. So there's some wiggle room there on how the lender's going to get paid one way or the other. How do you want the lender to get paid? But in this particular transaction, there's an origination fee of $995. This lender is very proud of this relatively low origination fee. And this lender does it $995 regardless of the amount of the loan. A lot of lenders will do it as a percentage. Some is 1% of the loan amount. So on a $250,000 loan would be $2,500 loan origination fee. So that's a great low rate right there. And then there's an appraisal fee of $475. With many lenders, this is paid outside of closing. because sometimes the closings don't happen, the buyer terminates, and we want to make sure the appraiser gets paid. But in this particular one, it's paid at closing. Credit report of $26.15, flood certification 11. Tax service fee is a one-time charge of $75 that goes to a company, CoreLogic in Austin, Texas. And for $75 for the life of the loan, in this case for 30 years, CoreLogic is going to come and get the necessary funds out of the escrow account to pay the taxes for the buyer. And then there's a relatively new line here, the technology platform fee. Ellie Mae is charging $82 for the lender to use the software to put all this loan information together. You won't see that on some loans because the lender will roll it into the loan origination fee. This particular lender is so proud of that low $9.95 loan origination fee, they didn't want it to go over $1,000, so they have a separate line item for technology platform. Title insurance is required by the lender, and it's divided into two parts. This is just the part protecting the lender for title insurance. Further on down on this page, there will be a line item for title insurance covering the buyer's equity in the home. And then the closing attorney's fee is the low rate of $775. A lot of attorneys are over $1,000. So anyway, those are the numbers here on the top of the page. Now let's take a look at the numbers below. Okay, we're getting there. We're now on the second half of the second page of the buyer's closing disclosure. We've got debits to the buyer of $90, that's $26 to record the deed and $64 to record the mortgage going to that county, in this particular example, Durham County. We've got a debit of $1,057 for 1 year of homeowners insurance. It doesn't have to be that number. It could be whatever insurance company the buyer wants to use, whatever their annual premium is for 1 year of homeowners insurance. So they could have shopped around. I have suggestions, and this number could have been a bit lower, maybe not as good of service, or not this debatable, but this number is variable. And then prepaid interest. Now let me talk a little bit about this prepaid interest in this particular example from January 11th to February 1st of $674. If somebody's renting a property and it comes around to February 1st and they're paying their rent, they're paying for February, all right? But when you have a mortgage and February 1st comes, your mortgage payment is paying for January, pays for the time behind, okay? So in this particular transaction where these people are purchasing a house on January 11th, their first mortgage payment is due March 1st, which is going to pay for February. But what about these last days of January? That's what this interim interest is. And so know that it is true that if you close on a home at the end of the month, your closing costs will be less because this number will be less. But you don't get to enjoy the house for those last days of January. So it's not really cheaper to buy the house at the end of the month because you don't own the house as long, but it is true that the amount of money you'd have to bring to closing would be less. And then building up the escrow account. So in this particular example, the lender is saying, let's take out enough money, let's take out some money and put it into escrow so that a year from now, when it's time for this buyer to renew their 1 year policy for homeowners insurance, we're not waiting on that last mortgage payment to come in to have enough money. So let's take out 3 months of $88 a month or $264, and we'll put that as a buffer in the escrow account. And let's take out 7 months for taxes because the bill comes out in July and this closing is in January. And 7 months of taxes in this example is $1,982. Well, the federal government has formulas that don't allow the lender to put too much money into escrow account. So the government says, no, lender, we need to make an aggregate adjustment here and give a credit back to this buyer of $704. So we're only going to allow you, the government tells the lender, to take from the buyer $1,541 and put that into escrow. So that's where this number comes from. So the escrow account is initially being funded with $1,541 of the buyer's money. Now know that on the next page we're going to get to, the buyer is going to get a credit from the seller for the seller's estimated portion of the 2011 property tax. Now this particular closing is in January, and it's January 1st to December 31st, so it's a very small credit. But if this closing were taking place, let's say in June, then the buyer would be getting a credit for half a year of taxes. But that wouldn't affect what's on this page. So you might see that the closing cost would be some big high number. Just know that there's a credit on the next page that you're getting for the seller's portion of the property tax. All right, but anyway, moving on down, in this particular case, the buyer opted to have a survey done. Always a great idea, and I have a video on that, but it's completely optional. In this particular case, the survey cost the buyer $475 is part of the closing costs. Then the title insurance protecting the buyer's equity in the home is $134.50. So the total closing cost for this buyer is $6,842.51. All right? Now let's do the last page and put all this together. Okay, so let's pull all these numbers together for the buyer. We've got a sales price of $312,500. Buyer's closing costs totaling $6,842.51. And the buyer is settling up with the seller for prepaid homeowner association dues, but that the seller paid for the entire year. So the seller is getting a credit of $169.73. The buyer is being debited that amount. So when you add those together, the total amount due from the buyer is $319,512.24. Where is all that money coming from? Well, the buyer has paid earnest money of $2,000. That counts towards the purchase price. The buyer is borrowing $250,000. The buyer is getting a credit from the seller in lieu of repairs of $6,400. The buyer has already paid $2,000 in the form of due diligence fee. Remember, both the due diligence fee and the earnest money count towards the purchase price. The seller is giving the buyer a credit for prorated property taxes of $102. It might seem like a small amount, but remember this closing is January 11th and the property taxes are January 1st to December 31st. So it's a small credit. So now the buyer is responsible for paying taxes for the whole year after this. So the total amount paid by or on behalf of the buyer, when you add all these numbers up, is $260,502.41. And on this page, you add the numbers up. They don't add down. So the total amount due at closing is the difference between the $319,512 and the $260,502. The total amount due at closing is $59,000.83. So that's a summary of the process. I hope that this made some sense. If not, please reach out to me. I'm available 7 days a week. My contact information is below. Be happy to be of service. Thank you very much.